Thank you for joining us today at the ESG panel of this year's Investment Advisor Association conference. I trust that you all have enjoyed the conference so well. I'm Gwen Williamson. I'm a partner in the investment management group at Perkins Coie, based here in DC. I represent investment advisors, funds, other players in the asset management industry, including a good number of clients who focus on ESG investing. And I am joined today by a number of members of our asset management community who I will ask to introduce themselves. Anthony?
Great, thank you, Gwen. It's great to be here. My role is Director of Responsible Investment Strategy at Calvert Research and Management, which became part of Eaton Vance about a little over 4 years ago, and then very recently, as in Monday, became part of Morgan Stanley Investment Management. So look forward to our discussion. Thank you.
And I'm Sean Murphy. I'm Vice President in the Legal and Compliance Department at EIG Global Energy Partners. Thanks everybody for joining the webcast today, and look forward to talking about these important ESG issues. EIG is a private equity and private credit specialist investment manager. We focus on private investments in energy and energy-related infrastructure on a global basis. We invest across the energy and energy-related infrastructure value chain, so from everything from power, renewables, midstream and upstream energy companies. And we've had ESG policies and processes since 2010, and they're continually evolving.
Thank you all. Sorry.
Last one. Hi, Bob Toner, just introducing myself, Chief Legal Counsel from William Blair Investment Management, and we manage client money globally.
Well, we've certainly got a lot to talk about this afternoon. ESG, has been a continuing trend among investors, and certainly the regulators, including in particular this week, we've heard a lot from the SEC about its plans for ESG. This was not terribly unexpected, given the statements of Acting Chair Lee's perspective on ESG disclosures and initiatives in the past. But just real quickly, we will run through what we've heard from the SEC in the past few days on ESG, and then invite our panelists to share their responses to this news from the SEC, and also a little bit more about ESG at their firms. So the first thing we heard this week from Commissioner Lee is that the Division of Corporation Finance is going to review public company filings for compliance with the SEC's 22 interpretive guidance on the disclosure around climate change. The staff is also going to revisit and update that 2010 guidance. I think there are definitely a lot of changes to the world and ESG related disclosures since then. So it will be interesting to see what the updates to that guidance are. Shortly on the heels of that announcement, the SEC Office of Investor Education and Advocacy came out with a ESG Funds Investor Bulletin. It's designed to educate mutual fund and ETF investors about ESG investing, and focuses on the lack of standardized ESG data for public companies in the US, as well as the non-standardized ESG practices among asset managers, which are something we'll talk a little bit more about today. Also this week, Gary Gensler, who of course is President Biden's nominee to take over the chair role at the SEC, told the Senate Committee on Banking, Housing, and Urban Affairs that he will pursue climate risk disclosure rulemaking and might also consider disclosures for other ESG-related issues. Then the SEC announced its 2021 exam priorities, which will include a look at registered investment advisors' ESG practices. The disclosure there will be the focus there will be on disclosure around strategies both at the fund and advisor level. The staff will be looking at consistency and adequacy of the disclosures and the related practices, including proxy voting. Interestingly, the staff will also be looking at how shops' business continuity plans are designed and contemplate climate-related events that could interrupt business operations. And then just today, just recently, just right before this meeting, actually, the SEC announced its enforcement task force on climate and ESG issues. This will be led by Kelly Gibson, who's the acting director of the enforcement division. She'll work closely with the new senior policy advisor for climate and ESG at the SEC. And interestingly, this task force is going to use data mining to look at gaps or misstatements in public company disclosures around climate risk. And we'll also, again, look at investment advisors and funds, ESG strategies and compliance related concerns. Sort of the biggest there, of course, being the greenwashing problem. So that was a long, but I hope succinct summary of what we've just seen this week from the SEC. I think we are likely to see more. And I will invite my panelists' reactions.
Sure.
Well, I guess I'll start and, Sean, yeah, go right ahead.
Sure. So my initial reaction, and Anthony and I were kind of talking about this before the panel, in terms of the kind of the examination priorities specifically, it seems to be consistent with what we've seen in the past few years, which is that, the SEC is going to be focusing on making sure that you're practicing what you're preaching. From an investment advisor perspective, what some of the things that we're going to be taking a look at is a gap analysis of our ESG related policies and procedures as compared against, for example, our marketing materials, to make sure that what is in our marketing materials for our products and for our advisory strategies is consistent with what's in our policies and procedures. And I think that is a good first step in terms of addressing some of the examination priorities. But what Anthony and I also discussed beforehand was that, this focus on climate, on sort of how investment advisors are dealing with risks associated with climate events, that actually has us kind of looking internally on as to how we're, if there's a major superstorm Sandy or something similar, how we as a business will operate. Anthony, maybe you can expand on that a little bit.
Yeah, no, I agree with you, Sean. I thought that was really interesting. We focus so much in the investment management business to evaluate how issuers, operating companies are managing these issues, and with a rigorous and robust ESG research process, we form investment decisions and ultimately portfolios for our clients. I think with this guidance, it's clear that they want us to turn the mirror on ourselves as well and think about some of these operational risks as they relate to our own activities, to our businesses. So in addition to what you point out is how our investment advisors thinking about physical risks associated with climate. I think there was also a focus on data security. I think they're going to be examining how advisors are managing and stewarding and protecting our clients' data, which of course is a key S factor of the E and the S and the G that we use to evaluate companies as well.
I guess my one reaction is that it's probably about time. We're finally catching up to the rest of the world, and I think collectively all of us would agree that there is a space for people who are interested in having products that either contemplate ESG factors or are specifically ESG or sustainability factors. And some of the actions that the staff is taking will be beneficial, really beneficial to us in our industry because it will give us more transparency for what operating companies are doing. But the price of admission is you have to do the things that my co-panelists were talking about. We have to actually walk the walk.
Yeah, maybe just to put an emphasis on that, I think you're absolutely right, Bob. The state of ESG investing is that we have better tools and better data than we had years ago, certainly pointing back to 2010 guidance that you mentioned, Gwen. But the world has really changed. Companies are doing a much better job disclosing, even though it's not a compulsory system, it's a voluntary system. We've learned about the value of financial materiality, which is critical for a manager to consider when they're doing this analysis. And the marketplace really needs sort of clarity around a framework in terms of what all the various managers are doing in terms of implementation. So I think this is long overdue, and hopefully we'll be able to kind of strengthen the framework and the overall system and the platform that we have to do a better job for our clients.
Yeah, let's hope that it does that. I mean, the lack of standardization in the ESG space in the U.S. certainly poses hurdles in certain places. I know. So I too am optimistic about the impact of these developments. Thank you all for sharing a bit about what's going on at your firms with ESG. Maybe we could talk a little bit more about growth that you've experienced, client demands and the like. In my practice, I've certainly experienced with family offices, for example, shifting preferences among the generations, younger generations taking over management of the family's money, for example, being much more keyed in with values, impact-oriented investing. But I think we're also seeing it, from the retail side. Main Street is certainly invested as well, and would be interested to hear how you all are experiencing and thinking about that.
Shall we change up the order? Bob, do you want to go first this time?
Sure, I'd be glad to. And by way of background, so William Blair actually is on both the buy and the sell side. I happen to work supporting the buy side. But the interesting development is we've got a private wealth group, and we have seen some people that are in family office arrangements or other larger non-institutional investors who really are focusing in on trying to make an impact with their investment. And we've got a couple of people who are a little bit more focused on that. On the institutional investment management side, we're seeing a little bit of it in the U.S. And it is a real gating issue in the EU. We've had a couple of clients that basically have said, if you're not willing to work with us to meet our standards, and frankly, they're different depending on which client you're talking to, then we're not going to continue the conversation. And it's also been a topic of discussion for our institutional sales and our investment banking side, because there are a lot of companies that are now being asked questions by the likes of my investment managers, and I'm sure they've been talking to Calvert for a long time, and they are trying to figure out what should we be doing and what do people really care about. Now, Sean, if you've seen the same kind of thing, or
so EIG as a kind of private private equity managers, we saw a lot of our LPs, the sentiments from our LPs in Europe kind of be more advanced than in other regions, but it's starting to pick up more, particularly in the Asian and Pacific regions. But we're also seeing, institutional, public pension plans in the United States who are changing their investment policies to have, actual percentage allocations to ESG or zero carbon, net zero sort of allocations. So that's something that we've noticed recently. We also have had scenarios where we have specific LPs that are looking for kind of specific reporting. So it'll be interesting to see, particularly as you have these regional regulations and reporting requirements come into place, to whether or not those end up trumping what are now client-specific needs. So, for example, in the EU, the SFDR and the taxonomy regulation, and there's going to be more, and it's going to be kind of a patchwork quilt, I think, for a little while until this becomes consistent. But it'll be interesting to see if some of those new regulations and reporting requirements will kind of trump those client-specific requests.
And maybe I'll just point to sort of the growth. As you pointed out, Bob, Calvert is, kind of a pioneering intentional ESG manager with roots back to the early 80s as one of the very first companies to get into this space. But I talked about what we're doing today versus 2010. Obviously, responsible and sustainable investing is quite different than it was decades ago. We benefit from much better disclosure, and we benefit from learning about financial materiality. I think we can really clearly connect the dots from a risk and return perspective. And so I think the overall approach to money management in this space has really been strengthened to the benefit of clients and investors. We manage about $30 billion across more than 30 investment strategies, all of which follow the Calvert principles and are sort of consistent with our goal of a dual mandate of competitive performance, but also positive global impact. So we try to offer access to the global capital markets for responsible investors. If we and growth has been significant over the last several years. And if you want to learn more about the growth of our industry, I think to consider John Hale's work at Morningstar. He does an annual landscape report. This is pointed at the mutual fund and ETF space, to be clear. But this last year, about over $50 billion went into the relatively small universe of intentional ESG funds. I think he counts about 350 funds and ETFs that sort of qualify as intentional strategies. 50 billion is up about tenfold from 2 years ago, when about 5 billion. And therefore you have many managers wanting to get into the space as well. Tremendous, I think, client acquisition and growth opportunities. Part of this growth, I think, we're seeing is some of it is generational, some of it is demographics. I totally agree, Bob. With wealthy families, the younger generations have more influence now in terms of how the family assets are invested and are part of sort of that driving that interest. What we've seen is that for years, responsible, or let's call it SRI investing, for years was a way for sort of values-oriented investors to economically express their priorities, their beliefs, in their portfolios. Today, I think there's a large cohort, and it's growing, of investors, not just millennials. They think that companies that are doing a great job managing the material, environmental, social, and governance factors, these sort of non-traditional areas of capital, if you will, companies doing a great job managing that potentially are going to be more attractive investors. And so I think that's why we certainly continue to serve that values-oriented investor. Happy to do that. But I think the growth is with sort of this traditional or profit-seeking investor that thinks that companies that are doing a great job about their diversity or thinking about their climate risk mitigation are going to be excellent investments.
Well, and we've seen, I think John Hale at Morningstar has written about the performance of those types of funds and strategies over the past year, and generally speaking, funds with strong ESG scores, so to speak, have performed well during COVID, I think, relative to their peers. So that's an interesting tidbit that I think people will cite for a long time to come. Sean, you mentioned the SFDR, and so maybe we can move on to that. That, of course, is part of the EU regulations around ESG. We won't have time to get into all of them, but suffice to say that they are substantially more developed than those here in the U.S. The SFDR has an initial compliance date of next week, March 10th of 2021, but there are still RTSs being finalized. Those are regulatory technical standards. And what the SFDR does is it requires asset managers, insurers, and pension funds to disclose sustainability risks in their investments. There are about 50 metrics, roughly half of which are mandatory disclosure items. Extra disclosure is required for ESG funds and other financial products, including pre-contractual disclosures in certain circumstances. And importantly, under the SFDR, there are two types of investment products. These are established at Article 8 and 9 of the regulation. The first group are deemed sustainable investments, those with environmental or social objectives. And then the second group is products that don't meet the requirements of being a sustainable investment, but that do promote environmental and or social characteristics. The SFDR requires asset managers to integrate ESG factors into their investment decision-making process as part of their fiduciary duties. And looking at that entails a consideration of potentially adverse impacts of investment decisions on ESG matters, including, of course, the environment. This regulation is really sort of sweeping. It applies broadly to asset managers, whether or not they are ESG oriented or advertise themselves that way. And it really is designed to encourage ESG investing and discourage exaggerations of claims around greenness, again, the greenwashing problem. In my practice, what I've seen most pointedly here recently about the SFDR is corporate clients asking for guidance on how to respond to questionnaires from EU asset managers on the disclosure items that they're now required to make. I'm curious what you all have done with the SFDR and how you maybe see it affecting you down the road.
Yeah. So just at a high level, I would encourage those legal and compliance folks that are listening. It's a pretty complicated regime. I think as I've kind of dug into it, I think when I kind of break it down, the SFDR in particular, I break it down to product level requirements and then manager level requirements. And so I think kind of the first step that we took was kind of understanding if we are in scope and what products that we have are that might be in scope. So I think that's probably a good place to start if you're a manager with products that are marketed into the EU, which is I think kind of one of the triggering factors. We have thought about how this is going to change to the extent as a manager that we're in scope, how this is going to change our due diligence questionnaires for our ESG due diligence questionnaires for the companies that we're seeking to invest in, because we think that we will need to incorporate some of the questions we will need to incorporate questions in order to have responses to the disclosure requirements for the adverse impact indicators of the SFDR. But sort of other than that, there's a lot of specific issues on the periphery. Like if you're using if you have an AFM in the EU that is managing one of your funds and you're a delegated PM, how does that work? So I just encourage folks to just kind of think about the complexities of the SFDR and think about where their firm and their product specifically fit to determine how it will impact the firm.
Right. And we went through a very similar exercise where. So fortunately, picking up on something that Anthony said, we've been over the last 4 or 5 years making a more concerted effort to, within our research database, make sure that the analysts, when they go out, are being very mindful of the sort of ESG questions to ask based on specific industries. And I would agree with Sean that the rules that are being implemented now and in the EU are quite complicated. So definitely look for some experts to help you out with that. But the other part that is not good nor bad, it's just something to be aware of, is they are, in my opinion, very laser focused on environmental issues. And the shame of that is for people who are looking at the whole range of ESG issues, if you're not really there's a risk to get the top tier, the Article 9. You have to be an environmental impact fund. That seems to be the case, and so it's kind of it has a little bit of a feel of a name and shame. So if you're not there, you have to explain why you're not there. And so I know there's been a lot of consternation internally at my shop that, we feel like we're doing a lot, but we feel like we're going to have to disclose something that makes it look like we're not. So that's where legal and compliance folks put on their kind of therapist hat and get the business people through it and say, no, it's really not as bad as it might appear. And there is going to be opportunity, because once you're categorized, it doesn't mean you're stuck there forever. It just means that's where you're categorized for now.
Well, and that is
I think
what we
related
try
to
to
that,
do.
Bob. Oh, sorry, Gwen.
Sorry, Anthony, go ahead.
I was just going to say, I think related to that, Bob, I think you're going to see a lot of managers who sort of maybe undersell themselves a little bit. You're going to see managers who think, well, I'm really an 8, but I'm going to come in at a 6 because I'd rather go from 6 to 8 than be told to go from 8 back down to 6, and probably relatively few 9s, right? But we are obviously working through that process to meet the deadline as well. And frankly, what they're trying to do is they're trying to make it easier for investors, asset owners, consultants to sift through the dizzying kind of landscape of managers and strategies that are out there. Here in the U.S., the CFA Institute has an initiative to try to do that. The ICI, of course, is also they've got some work streams to work on this, to do a better job of for managers to accurately, appropriately describe the extent to which that they are integrating ESG considerations and research. Is their impact being delivered to that client or better, ESG exposures, and how do we illustrate that to clients? So I think we will we'll see this, but perhaps not the same kind, and maybe not as rigorous as what we're seeing in the EU, but we can anticipate at some point some sort of a framework to reach us here in the U.S. as well.
Yeah.
And one last.
Oh, go ahead.
Just one last point is that what I think there is like a pretty commercial side to this as well, right? Like Anthony, you mentioned, like you don't want to necessarily undersell yourself as a firm, but there's going to be managers out there that might want to consider, even if you're not in scope, might want to really understand what it means to be in scope as a manager, because you might have LPs or investors in Europe that become accustomed to getting the disclosures that a European manager is required to make. And you might have consultants in Europe or elsewhere that just in the DDQs, et cetera, are going to be asking for the same type of information. So I think that, it's all of this is coming. So it's something to kind of be front-footed on, and it'll be interesting to see how it all kind of globally kind of develops. But I think it's something to just be aware of, even if you're not necessarily in scope.
No, absolutely. And I think we're also, have seen suggestions that perhaps blockchain could be used as a way to, centralize the ESG disclosures of the world's companies. That seems a little far off, but perhaps we can touch briefly on some of the other frameworks that are currently in place, and I think used by U.S. asset managers. And in that vein, we have a question about whether we see the UNPRI playing a larger role in establishing or influencing ESG regulations and best practices. I mean, it's my sense that is already the case to a large degree. I think many asset managers have adopted the UNPRI as an advertising point, and then hopefully have also implemented accordant practices. Others, in addition to the UNPRI that we see out there, are the SASB, that's the Sustainability Accounting Standards Board. It has 77 industry-specific sustainability standards that are intended to allow comparisons between businesses. There's also the Global reporting initiative that is based in the Netherlands and has a similar goal as SASB. The Task Force on Climate-Related Financial Disclosures, the TCFD, it was created by the Financial Stability Board, and its goal is improving and increasing the reporting of climate-related financial information. There's also the Carbon Disclosure Project, the Climate Disclosure Standards Board, and the International Integrated Reporting Council. Those are all described in greater detail in the materials for this panel, and so we won't go into too much more detail about them, except to say that that all of those that I just listed, except for the UN PRI, announced last year that they were working together on an initiative to adopt a uniform standard that they all agree on. And so I think that could be the first big step in harmonizing things here in the U.S. I can't imagine the UN PRI being out of step with that, but would invite you all to share your thoughts on that. And then just to let folks know, we will move into the latter part of our discussion here, which will be a case study that I hope will address the other question that we've received so far, which is what advice would folks give to a firm that wants to enter this space? So just briefly, if you guys want to touch on the other standards, and then we can move on into the case study.
Maybe I'll just kick off here and welcome Bob and Sean's comments as well. So, Calvert, which is probably not a surprise, has been kind of an early collaborator and signatory to a lot of the important organizations that have formed the foundation for our industry. So we joined SASB 10 years ago when it started. We've been part of their investment advisory group, working very closely with that organization as they do the really critical work to develop a framework, for issuers to better, more consistently disclose their performance on material ESG data, and I think or ESG issues. And a terrific resource for anybody who's not familiar with it is that materiality map where they lay out the 77 industries and what are the ESG factors that are most material. So I encourage people to check that out. PRI is obviously critical. It was slow early on, but I think they now have over like 3,700 signatories, asset owners and asset managers who have committed to those principles. Very high level kind of aspiration principles. I did see Fiona Reynolds, their CEO, come out very recently and say, because I think what we know is that a lot of people signed up for the, committed to the PRI, and then they kicked off sort of an auditing process over the last few years for managers to actually prove that they have operationalized and taken up the priorities of those principles. Now, there was an announcement by Fiona that they're going to start looking at managers and advisors voting practices, because there are an increasing number of ESG-related shareholder proposals that are filed, opportunities for investors and managers to vote. Presumably an ESG-oriented manager or an advisor in a strategy would support ESG proposals, but that, from what we know from media coverage and looking at the results, that often is not the case. So I think she has indicated that might be something that PRI is looking at. TCFD is critical because obviously we're looking for issuers to better disclose the risks that they face in their business related to climate. I think it's for companies to sort of sign on to TCFD as a good step in the right direction. Difficult with that framework to really sort of convert it to metrics and actually evaluate companies systematically. But I think what they indicated earlier in the last several months is that the SASB framework and that disclosure framework works for that TCFD reporting, which I think is good news for investors. So I think all these organizations are critical, but a single standard around disclosure is, to your point, I think is critical.
Yeah, absolutely. Okay, well, so we thought that it would be helpful to sort of run a case study here, and we will go through sort of everything that a firm might need to consider in developing an ESG strategy. We'll talk about defining the strategy, describing this strategy, implementing the strategy, obtaining and managing data, and then reporting on the strategy. So let me, maybe I will direct the questions here so we can not have a free-for-all, because I know that you all have so much to say. Sean, maybe you could start out with, in defining an ESG strategy, how does your firm approach that? Are proxy voting and shareholder engagement part of the strategy? And how do conflicts fit in? For example, if you have conflicts between the strategy and how your firm has approached investing more generally, and do you have policies and procedures at the firm level for how you go about complying with your advertising? Say, do you have a very robust recycling program and a diverse board, et cetera? Those types of things.
Yeah, sure. So, we kind of think about it in there's kind of four tenets. We have our kind of investor engagement, disclosure report and reporting, our portfolio company engagement, and then due diligence. So, those are kind of our four main themes that we think about in our ESG practice, I would call it. We have a firm level ESG policy that kind of applies at the firm level. But those four tenets are kind of what drive us. So in terms of investor engagement, we have ongoing discussions regarding our ESG strategy with our investors and LPs. In terms of disclosure and reporting, we have LP specific reporting, and then an annual ESG report that goes out to investors as well. And as we mentioned, there might be more reporting that is mandated by regulators. And portfolio company engagement and ESG due diligence kind of combine together. We're in the private market, so when we're making investments or financing private companies, we engage them prior to making the investments, and we engage them continually with annual and ad hoc data requests. Data is a very important part of ESG, and we've found, at least in our kind of private market space, that there's really divergent data from data providers. So going to the actual portfolio companies and getting data across, we look for over 150 data points, and getting it directly from them is kind of how we conduct the due diligence. From a conflicts perspective, it does raise, having a firm level ESG policy can raise some issues. So for example, if you're a manager that's you're starting a new ESG strategy, so it's kind of a nascent space, one thing you sort of are going to have to consider, and what we have had to consider, is if you're managing, for example, like a segregated account or a separate account for a client, and that client, you've agreed on a set of investment guidelines. If it's not clear to them that you have a specific ESG policy that's going to be applied to their mandate, that could really be kind of in conflict with, the fiduciary obligation that you have with that client, and just kind of their understanding. So it is critical to think about the diversity of your products and how you're going to be implementing an ESG strategy, whether it's going to be product specific, whether it's going to be firm level. And I think that's something that's important to consider, and can create some interesting issues.
Absolutely, and important to get the disclosure on all of that. Right.
For sure.
Bob, Anthony, I know you all have so many ESG strategies that you're well beyond the stage of starting this, but I'm sure you have insights to add.
Sure. Yeah, you could take this in a lot of different directions, but maybe we'll just touch on data. So there are obviously so many data providers out there. I think a great business idea for somebody looking for an opportunity is to start an ESG data provider, because you're likely to get acquired by a large agency or data aggregator. We've certainly seen lots of consolidation over the years. So I think that, as Sean indicated, the data is better. It's not perfect. And of course, we're still working with a voluntary framework from a disclosure standpoint. There is relatively low correlation across the data providers, the prominent data providers, particularly those that kind of roll up a score of a particular issue or operating company. Each data provider has its own view on materiality, their own view on sort of what are the most important issues to collect data on. We solve for that by using multiple data providers. We end up using about a dozen different data providers, and have a governance process for considering what is the best source of data for a particular issue area or KPI that we're trying to evaluate. And we also have forged a relationship years ago with a data science partner that has a great testing environment for our analysts to have access to and test sort of the efficacy of data points, of KPIs in the price discovery process. So lots of work behind the scenes to kind of ensure that we're sourcing the best data and it's decision useful information. To Sean's point, oftentimes we have to go directly to a company or to a governmental agency, a regulator, or an NGO to get data. So I think it is important for a manager to have the ability to create sort of custom KPIs, custom research points, if that's helpful. So I think that's focusing on the data. I do think that just to pivot to engagement, alignment of a proxy voting methodology, and the opportunity to engage with issuers and kind of drive for progress and better performance on material ESG factors, strengthening our position as an investor. That's a really important part of the narrative. So I think for a manager to think about getting into this space, I think they need to do it with intentionality. I think they need to do it sincerely, frankly. I think any investor who's excited about investing in these strategies, they'd like to know that their manager or the advisor is really doing it comprehensively, holistically, and have an engagement strategy to support the findings from the research process and the opportunities to encourage companies to improve. So those are a couple of things that I would offer.
Yeah, I agree with that completely, and I think that would form the strong foundation that it looks like the SEC is going to be looking for. And what they announced today, it is not all of it's not all that new, right? This was all sort of required by standing fiduciary duties, but we've just seen the staff be quite explicit that it's going to be looking in this space. Bob, anything that you would like to add on setting up an ESG strategy, data, proxy voting, all of that?
Well, I mean, a lot of the topics have been very well said, but I think one thing people need to be very honest with themselves on is there is pressure, especially in places like Europe, but as we've described in the U.S. as well, to be rather than holier than thou, greener than thou. And if you're not ESG, then you're not going to get the market share. There are certain strategies that are just really tough to fit into that space. And so even in the somewhat, in my opinion, rigid requirements under the EU rules, they've recently said, maybe investing in sovereign bonds is not going to be the place where you can have this kind of strategy. And there's been a little bit of easing back. Macro allocation strategies are also going to be somewhat challenging depending on what the underlying investments you use to get there. So I think that although there will be pressure to be able to say that you are all in on ESG, I think that people in the roles that all of us and a lot of the people who are attending the conference have to be the person to say, so there are certain lines that you have to be careful about, especially with the SEC now looking at things and with EU very clearly being on top of it, because it is a far worse outcome to be told that you've been misrepresenting facts than to not have, in the EU's words, an Article 8 or Article 9 strategy.
Bob, you bring up a great point there, and it relates to the data, which is the ability for us to do ESG research on issuers in asset classes or in regions where there just isn't disclosure. Right. Think about the municipal market, think about private issuers. We run high yield and bank loan strategies, so challenging to do the research on some of those issuers. You bring up sovereign, which is a challenging one as well. And the reality is that the data providers, there are specialist data providers like a GRESB, which obviously provides real estate data, which is helpful. But there are just there are just holes in the coverage for some of these asset classes. And so I think an advisor or manager has to develop a way to do some sort of creative research in some of these asset classes to get to the data and be able to properly assess how these issuers are managing the material ESG factors that they face, which can be significant in some of these markets.
Yeah, we've seen exactly that, right? When we're investing in an early stage company, for example, that might only have 5 employees or something like that. They might not have an employee that's dedicated to providing financing companies and private equity or private credit or banks with the data that they need to maybe comply with the regulation or to comply with an investor request or something like that. So data just continues to come up in these discussions.
Yeah, and you look at the small cap market, Sean. I mean, companies are penalized for a lack of disclosure. The reality with small cap companies, particularly you move down to micro cap, is that the folks running those companies, the management teams, they're just busy. They don't have a chief sustainability officer. They don't have the time to put out a glossy sustainability report, nor do they have time to complete the questionnaires that are sent to them by all the data providers. And so as a result, those companies are penalized and they end up with low scores. Doesn't necessarily mean, I'm not saying the disclosure is not important. It's critical. Was it Mark Twain who said sunlight is the best disinfectant? We often are looking for the information to be able to make assessments and investment decisions. But there's an opportunity for engagement with small cap issuers to get in there and sort of help them understand that taking the time to provide some disclosure will elevate their ESG scores, will probably attract more capital, will have a positive influence on their securities prices.
Yeah, agreed.
Well, that raises a question in my mind, and I think sort of moves to the next phase of questions here, which is describing and implementing your strategy once you've got it in place, right? Historically, ESG investing was done like along screening lines, right? You either screen out bad stocks like fossil fuels or even sin stocks like booze and the like, or you positively screen in only companies that fit a specific value set. But I think we've moved far beyond that in the U.S. asset management industry these days. And you all have talked sort of generally about what your firms do strategy-wise, but maybe you could talk a little bit more about that and what sort of requests for new types of strategies or even just questions that you are receiving from your clients, in the ESG space.
Right. So I would say I don't think William Blair is all that different from a lot of firms. So despite the market, whether it's an institutional channel, a retail mutual fund, or an EU product, there's a desire to come up with a strategy and stick closely to the strategy so that you can share your best ideas with your clients. But we're recognizing now that, particularly as it relates to outside of the US, having products that are more explicitly sustainability or ESG focused is something that that we're hearing from clients that they want to have. We very specifically in our CCAV products were told by a client that they liked our approach for one of our global funds, but it did not have enough sustainability elements in it, and unless we were willing to consider that, we would lose the mandate. And so they were a large client, and so we now have our original fund plus one that has more sustainability features. And we're now looking at these sorts of things in a more proactive than a reactive way. And I do, harkening back to something that was said before, I do really hope that the convergence of standards and more people agreeing to one standard is coming sooner rather than later, because the tricky things that you get into, I'll just mention this one and hand it over to the others. you have some larger clients that are very committed to the idea, and we had one recently that came on board. And it's not, even if you wanted to do an exclusionary list, it would be very challenging because one of their criteria was, okay, the issuers you invest in can generate no more than X percentage of carbon emissions. So that data is kind of sort of out there, but there were some other data pieces that they were asking for that were really very, very specific. And we were challenged to find data sources that would be precisely on point. So we really had to think about, more insourcing the work and doing the research and having the engagement with companies to say, okay, so give us this data, or make it available to the public so that we're able to consider investing in your company, because otherwise they're not going to be a portfolio company for that particular mandate.
Sean, do you want to go, and then I'll offer a couple things?
Sure. Anecdotally speaking, from a product perspective, we launched a new fund, an energy transition fund that was marketed globally, but what we and its investment objective was at the time 65% zero carbon investments and 35% natural gas. So getting away from oil, trying to capture this energy transition, which isn't not necessarily a unique style of fund. There are others out there, but what we've been seeing and talking with some of our investors is that that bucket of the natural gas side of it isn't really what they're looking for anymore. So this, fortunately, the objective of the fund allows us to go up to 100% zero carbon, but that's just like a very real world example of, in a private fund, how investor sentiment is changing over the course of, call it 18 months. When we initially went out, kind of pitched the concept of the fund, it was well received, but then as you market it, that kind of this is what happens. From the perspective of kind of defining a product or defining a strategy, I think it's important to make clear from a compliance perspective and a legal and compliance perspective in your disclosures exactly what you're doing, right? You don't want to be saying that you are more of an impact style fund when really you are just screening. So I think any of those, they're fine. They're all okay products. There's nothing wrong necessarily with being a negative screening fund or being an impact fund. It's just clear. You just need to make clear that what you're actually doing. And I think that's important from a disclosure perspective.
Yeah, absolutely.
Yeah, that's a really interesting point. Hopefully we'll have a moment maybe to talk about DOL and ERISA, the notion of screening versus kind of performance assessment. I think there were two really important developments that have occurred over the last 10 years. First of all is disclosure. I think it was in 2011, 10 years ago, that roughly 20%, maybe even less than 20% of companies in the S&P 500 were doing any sort of reporting or disclosure of their performance on ESG factors. And then the 2015 research that came out of George Serafeim and his colleagues at Harvard Business School, which really for the first time put financial materiality of ESG factors on the map. And, I think he looked back at 25 years and found that companies that were in the top quintile, top 20% of their ESG performance in areas that are financially material to their business outperformed the bottom quintile based on companies and their management of ESG factors material to their business, something like 370 basis points of outperformance over that time period. And so you saw managers, including Calvert, really try to embrace financial materiality and work that into the investment process. So I think it's important, and to bring it into the DOL context and sort of the murky guidance that we got last fall, is that if you're operating with just negative screens or with exclusions, hard to defend that as a pecuniary sort of research process, right? So I think what we really focus on at Calvert is making performance-based assessments, risk assessments, opportunities. The companies that we end up not investing in that don't meet the Calvert principles are companies that either face unmanageable risk in terms of their business models and low optionality to diversify away from that risk. Think tobacco manufacturers, for instance, or companies that face manageable risk. They're just doing a poor job kind of implementing their strategy to manage it. And I think that's been an important part of our sort of evolution. And I think as managers, advisors who are not doing ESG investing think about charting that course, I think to build the ability to evaluate and make performance-based decisions versus that kind of negative screening is a really important thing to think about.
No, I certainly agree with that. I mean, what we saw from the DOL last fall was really based in the sort of old notion, in my mind, that values-based or impact investing necessarily entails a introduction of additional risk and sacrifice on returns. And I think what we're seeing is that is not uniformly the case anymore. If it ever was. We've got a question on how the SFDR Article 4 sits alongside the DOL's rules. I think, and I will invite the rest of you to comment as well, but I mean, the Biden administration has indicated that those rules are under review under the executive order that President Biden put out, I think, on the first day of his administration, because they are part of a group of rulemaking that has scientific and public health related consequences. So it is my hope that the rules that the DOL adopted last year do not come to fruition. But I guess we'll have to wait and see about that. But I do think it's likely, given the flurry of activity that we've seen here recently in the administration from the SEC. And so we've just got a couple of minutes left. I will invite each of you, Anthony, Sean, and Bob, to weigh in on the DOL issue, and also to offer any key takeaways that you think are important for our viewers here.
Sure, happy to start. This has been a fun discussion, so thanks, Gwen, for leading us, and Bob and Sean for providing a great opportunity to have an important conversation on these topics. So I think with the DOL, I think what that guidance last fall created was just a lot of murkiness, a lot of uncertainty, and I think it's led to plan sponsors and fiduciaries to not move forward with thinking about adding an ESG fund to an ERISA governed retirement plan, which is too bad. There definitely are still organizations moving forward with it, so it hasn't totally ground to a halt. But I know that has been the impact. I think what that guidance, while not totally supportive of ESG, if you look through it, the expectation is that a fiduciary is conducting a thorough due diligence process and evaluating a manager's process efforts around building ESG strategies. And I think, as I just mentioned, if you have a performance-oriented assessment, whether it's risk or opportunity, then I think it can hold up. I think it can stand up, even with the way the guidance is currently written. I do think there's a challenge as it relates to QDIA, because that guidance does pretty clearly say that it's going to be tough for a plan sponsor to consider an ESG fund as a QDIA. But I think what we're going to anticipate seeing moving forward is hopefully better and more rigor around issuers' disclosure of ESG data. I think that's going to be to the benefit of managers, advisors, and clients. I do think that the onus is on all of us to do a better job of kind of reporting, illustrating to clients the kinds of exposures and impacts that we have in our portfolio. I think that's going to become table stakes. You said, I think, Bob, that it's table stakes in Europe is, currently. I think that's going to be table stakes across the industry. But exciting developments, and I think ultimately helpful to the work that we do for clients.
Right, and I'm just going to jump in real quick with an administrative item. I have just gotten word that I think not all were able to see the CLE code words that were supposed to pop up at the beginning of this presentation. The first one is 1, the number 1, and then ESG, so 1 ESG, and then the second is ESG 2, so ESG and then the number 2.
Yes.
All right, and we've just got a couple more minutes, but Sean, Bob, welcome your thoughts and any closing takeaways.
Sure.
Yeah, oh, go ahead, Bob.
So just quickly, I would say for those who are maybe just on the beginning of the path, Calvert does a good job, a great firm, and they have a great head start. But there really is an opportunity. I think we've mentioned the ways that different types of firms have approached this, whether it's in the private space, whether it's in more of a public space like we and Calvert tend to do. And it was just interesting. Anthony was describing, Calvert for quite a long time has been looking at things through this sort of ESG lens, and also more explicitly bringing in the financial aspects of it. Maybe more recently, we have always looked at especially governance, but also environmental and social, but also very strongly with the lens of, okay, so what does it mean for the bottom line of the company? I do think it's an exciting time with no offense to people who are in the ETF space, because this is something where I do think it very much plays into the wheelhouse of active managers.
Yeah, and I would just echo everybody and say, thank you for allowing me to join the panel. It's been great working with everybody. This is a very interesting space, and even as working at a manager that focuses on energy investments, which includes upstream and midstream oil and gas. We are seeing, this financial materiality point that Anthony mentions, which is that there are benefits to all of these, to investing in companies that have strong ESG practices. Very specific benefits, for example, for an oil company that's managing its methane in solid ways, we're seeing them perform financially better. Now that might be kind of oil is kind of a bad industry to think about in this context, but that's really just showing how an ESG practice can even apply in that context. From a legal and compliance standpoint, I think to me this kind of reminds me a lot of when AIFMD came out. We're going to have to think about these standards across the globe and even within Europe are going to be maturing, and we're going to have to kind of mature at the same time and work with the regulators.
Well, lots and lots going on. Thank you all for your time today. Please, folks, feel free to reach out with any questions. You can find me easily on the web, and I would be happy to forward your question to any of our other panelists in case they are not as easily reachable.